Picture this for a second. You own a contract that's supposed to be backed by real metal. Not a screenshot, not an IOU, real bars. You call to take delivery, and the answer you get is basically, we can pay you cash instead. Now here's the scary question. If this market is truly backed by physical supply, why would cash be the first offer? That's why this rumor has people sweating. A document in Chatter circulating online claims a roughly $2.7 billion COMEX default style event, or at least a massive emergency settlement situation tied to precious metals. I'm going to be careful with words here because leak and default get thrown around for clicks. Some of this is unconfirmed and some of it gets misunderstood on purpose. But even if the number is off, the underlying issue is real, and it's been building for years. The paper to physical ratio. People cite it as high as 180 to 1 in certain windows. And if enough players decide they want the physical at the same time, the whole system has a problem. So tonight I'm going to walk you through what COMEX actually is, what default really means in this world, how that paper to physical ratio is calculated, why it can suddenly matter a lot, and why this isn't just about gold and silver nerds. This connects straight into banking, collateral, derivatives, and confidence. And once confidence cracks, things move fast. Real quick, if you want more videos that break down confusing financial stories in plain English, hit the like button and subscribe. It helps the channel a lot, and it tells YouTube to show you more of this kind of content. All right, let's get into it. First, let me set the scene with a simple story. Imagine a stadium that sold 180 tickets for every one seat. Most nights it's fine, because most people don't show up. They scalp the ticket, they trade it, they cash out, they never try to sit. That's how paper markets work when everyone is happy staying in paper. But what happens the night a big concert hits and everyone shows up at the same time? Suddenly, the stadium has to do something it never wants to do. Admit it can de-deliver what it sold. That's the fear some traders have about COMEX, the big US futures exchange where gold and silver contracts trade. Futures contracts are supposed to be deliverable. In theory, if you hold the right contract at the right time and you follow the rules, you can get real bars delivered to approved vaults. In practice, most contracts are closed out before delivery. People trade price exposure, not metal, and that's not automatically evil. That's just how futures markets usually function. But here's where the tension comes in. If the paper claims get too large compared to the amount of readily deliverable metal, then the market becomes stable only as long as most people agree not to ask for delivery. That's not a real safety net. That's a social agreement. Now, what about that 2.7 billion number? Here's the grounded way to think about it. In commodity markets, the word default rarely looks like a dramatic headline where the exchange shuts down and admits failure. It can look more like delays, rule changes, emergency margin hikes, cash settlement incentives, contracts being rolled, delivery being discouraged with fees, or quiet deals behind the scenes where someone pays up to make a problem disappear. If markets start suspecting that physical is not as available as the paper suggests, that suspicion spreads. It doesn't stay inside precious metals. So ask yourself, if a market needs most participants to not show up, is it a strong market or just a calm market? Let's talk about the ratio, because this is where people get confused and where hype videos usually skip the details. The paper to physical ratio can mean a few different things depending on who's calculating it. Some people compare total open interest to registered inventory. Some compare trading volume to vault stocks. Some even compare the entire global derivatives exposure to a slice of deliverable bars. And depending on the denominator you choose, you can get a number like 50 to 1, 100 to 1, 180 to 1, or even more. But the most important version of the ratio is the one that answers this question. How many active claims could realistically demand delivery compared to the metal that is actually available for delivery right now under the exchange's rules without somebody panicking? Because COMEX vaults usually list two big categories, eligible and registered. Eligible means the metal meets the specs and is in an approved vault, but it's not committed to delivery. Registered means it's been put into the system as deliverable inventory. That distinction matters, because if everyone points to the total metal sitting in vaults and says, see, there's plenty, that can be misleading. A lot of that metal may belong to someone who has no intention of letting it go at today arrest price. So the real question is not, is there metal in the building? The question is there metal for sale, for delivery at the current paper price when delivery demand spikes? And this is where the story gets spicy. Because when physical demand tightens, you start seeing weird symptoms. Premiums rise in retail markets, delivery times extend, lease rates change. Is the futures price a real price or just a financial price? That's how a slow confidence leak turns into a run. Let's make COMEX delivery feel simple. A futures contract is basically an agreement. A buyer and seller lock in a price now for metal that can be delivered later. But most people never want the metal. They want price movement. They trade in and out. The positions cancel out. That's normal. When you get close to delivery month, some traders roll their position, meaning they close the near month contract and open a later month contract. That keeps them exposed to price without taking delivery. Again, normal. Delivery happens when someone stands for delivery and someone else issues delivery. Behind the scenes, it's a warehouse receipt system tied to approved vaults. It's not like a truck pulls up to your house with gold bars. It's accounting, approved storage, and a chain of custody. So why do people say the system is strained? Because bullion banking and metals trading have a unique feature. They can look fully backed as long as delivery demand stays predictable. Banks and market makers provide liquidity by selling contracts and hedging. They earn spreads, they manage inventory. They borrow metal, lease metal, swap metal, and hedge. It's a complex web, and it can function smoothly until too many people on one side decide they want the real thing at the same time. Here's a key point. A paper claim is easy to create. A bar is not. A bar requires mining, refining, shipping, assaying, and vaulting. That takes time. Paper can expand in milliseconds. Physical cannot. Now imagine a moment where physical becomes more valuable than paper exposure. That could happen for a lot of reasons. Geopolitical tension, sanctions, a supply shock, a big player deciding they want metal outside the financial system, or simply a loss of trust in counterparties. When that shift happens, the first move isn't always a dramatic default. The first move is often a quiet change in behavior. Fewer people are willing to part with physical, even if the paper price says they should. And that's where a high paper-to-physical structure becomes fragile. If there are many more paper claims than deliverable bars, then the system relies on two things to stay calm. One, most participants must keep treating contracts as financial instruments, not delivery instruments. Two, big players must keep providing metal liquidity when asked. But what if those big players are the same ones under pressure elsewhere in the financial system? Let's talk about why this can break banking, because that sounds dramatic, but the logic is real. Banks don't just hold cash, they run balance sheets, they manage collateral, they hedge interest rate risk, currency risk, commodity risk. They also operate in a world where a lot of confidence is built on the assumption that markets will stay liquid. Gold and silver markets feed into that because metals are used in collateral chains, and because bullion banks run large derivative books. If a bullion bank is short futures as part of a market-making role, that's not automatically bad. But if delivery demand spikes while physical is tight, the bank may have to scramble for bars, pay up for metal, or offer cash settlement. That scramble can create sudden losses, sudden margin needs, and sudden liquidity stress. And here's the ugly part. Liquidity stress spreads. If a bank has to post more collateral here, it pulls collateral from somewhere else. It sells assets. It tightens lending. It reduces risk. That tightening hits the broader market. So when people say this isn't just a metal story, that's what they mean. It's a story about confidence and collateral. Now, about that 180 to 1 number. Let's translate it into normal human terms. If open interest represents a lot of contracts and only a small portion of metal is registered for delivery, the ratio can look extreme. Critics say that proves manipulation or fraud. Defenders say most contracts never intend delivery, so the ratio isn't a problem. Both sides miss the most important point. The ratio is not a problem. Until it is. It's like fire insurance. You don't need it until the day you really need it. And this is where the idea of a default becomes more about behavior than legality. If enough longs want delivery and the system responds with, "Here's cash, please go away," the market may technically function, but the promise has changed. People bought exposure to an asset that was marketed as deliverable. If delivery becomes optional in practice, the contract becomes a different product. Now, let's connect this to the alleged $2.7 billion situation in a responsible way. I'm not here to tell you, yes, this happened exactly like this. What I am saying is, markets have had moments where large sums were needed quickly to keep a delivery or settlement process smooth. That can happen through higher premiums, emergency borrowing, incentive payments to roll, or negotiated cash settlements. Those are exactly the kinds of quiet pressure release valves that prevent loud failures. So if you hear $2.7 billion, don't lock on to the exact number like it's a movie prop. Focus on what it represents. The cost of maintaining the illusion of endless liquidity when physical becomes scarce at the quoted price. Now, a lot of people ask, why wouldn't the exchange just force delivery no matter what? Because exchanges are not charities, and they're not built to create chaos. They're built to keep trading going. If forcing strict delivery would cause cascading failures, the incentive is to keep the machine running, even if that means bending expectations in stressful times. And if you're thinking, okay, but wouldn't that destroy trust? Yes, that's the trade-off. Short-term stability versus long-term credibility. You've probably seen something similar in other markets. When a market breaks, it rarely announces itself in a clean way. It shows up as rule changes, trading halts, margin changes, temporary restrictions, or price gaps between the official market and the real-world market. So what should you watch for if you want to know whether this story is real pressure or just internet drama? Watch registered inventory trends versus delivery demand. Watch how much metal is being moved into registered versus leaving. Watch whether delivery months are seeing unusually high standing for delivery. Watch spreads and signs of stress like backwardation in unusual places. Watch lease rates, because when leasing metal gets expensive, it can signal tightness. Watch the premium on coins and small bars, not because that drives COMEX, but because it reveals retail stress and sentiment. Most importantly, watch whether the market's behavior changes. Do more people insist on physical? Do more people talk openly about counterparty risk? Are more deals happening off exchange to source metal? Because once enough participants start asking the same question, the paper to physical math stops being academic and starts being a countdown. Let's game this out like a story with two possible endings. In the controlled ending, the system does what it's designed to do. Prices rise enough to bring out supply. Some holders decide to sell physical into the market because the price is finally attractive. The exchange and big players manage deliveries, maybe with some cash settlements and incentives, but without a public crisis. The headlines fade. Most people never notice. In the messy ending, something flips fast. A big buyer wants physical and won't take cash, or several buyers do that at once. A vault category shift happens and registered metal drops at the worst time, or geopolitical events push institutions toward hard assets. Suddenly, the market has a choice. Deliver metal that isn't there, or admit that paper gold and real gold are not the same thing. In that messy scenario, here's how it can hit banking. First, you get margin stress. If prices move violently, futures positions demand more collateral. Banks and trading firms have to post cash or treasury collateral fast. If they can't, they cut other positions. That can push volatility into unrelated markets. Second, you get liquidity hoarding. When institutions get unsure, they stop lending as freely. They pull back from market making. Bid-ask spreads widen. That makes everything feel more expensive and more fragile. Third, you get collateral chain problems. A lot of finance is built on rehypothecation, meaning the same collateral can be pledged multiple times in different forms. If trust drops, that chain shortens. Everyone wants the cleanest collateral. The tightening can feel like a credit crunch. Fourth, you get a credibility reset. If enough participants believe the futures market price isn't the true price for immediate physical, then the market splits into two layers: financial price and physical price. That split is poison for a system that needs a single reference price. Now, you might be thinking, but why would gold and silver be the trigger? Aren't these markets small compared to bonds or equities? They are smaller, yes, but triggers don't have to be the biggest thing. They just have to be the thing that exposes leverage and weak promises. Sometimes the spark is in the corner of the room, then the fire spreads to the curtains. Let me give you a simple example. If a major player has a big short exposure that's hedged on paper, and suddenly that hedge doesn't need to behave like it's supposed to because physical tightness changes settlement dynamics, that player's risk model breaks. When risk models break, they don't break politely. They force liquidation, higher haircuts, and emergency funding needs. And this is why the paper to physical concept has become so emotional online. Because it's not really about metal fans. It's about the public slowly realizing how much of modern finance is based on layered promises. Now let us zoom in on what a so-called COMEX default would likely look like if it ever happened in a way the average person could see. It probably wouldn't be a banner that says default. It would look like a wave of unusual cash settlements. It would look like delivery rules being adjusted. It might look like higher fees or incentives that strongly encourage rolling contracts instead of taking delivery. It could look like sudden changes in what qualifies, where it can be delivered, or how fast. It could look like a major divergence between futures and physical premiums that doesn't close quickly. And if the number floating around, like $2.7 billion, represents emergency money used to smooth something over, then the real question becomes, how often will that be needed going forward? Once could be a fluke, twice could be stress, 3 times becomes a pattern. So what should you do with this information as a normal person watching from home? First, don't let anyone panic you into a dumb decision. This video is not financial advice. My goal is to help you understand the plumbing so you can interpret headlines better. Second, focus on signals, not slogans. 180 to 1 is a signal that leverage exists. It is not, by itself, proof that the market will explode tomorrow. The market can stay leveraged for a long time. What changes everything is behavior. When more people want the exit at the same time, when more people demand physical, when trust drops. Third, watch for narrative changes from mainstream sources. When major financial outlets start treating delivery stress as normal news instead of fringe talk, that's when you know the topic has moved from rumor to risk. And here's a question I want you to sit with. If the world is heading into a period where supply chains are shakier, geopolitics are louder, and trust in institutions is thinner, do you think people will want more paper promises or fewer? Because if the answer is fewer, then the value of true, unencumbered assets goes up, and the cost of maintaining paper-based pricing systems goes up with it. Now I want to hear from you, because this is one of those topics where the comment section is actually valuable. Do you think the COMEX delivery system is strong enough to handle a real spike in physical demand? Or do you think cash settlement becomes the unofficial exit door? And when you hear a number like $2.7 billion tied to keeping things quiet, does that sound like a one-time patch? Or the beginning of a bigger problem? If this video helped you understand what's going on, share it with a friend who keeps hearing COMEX default on social media but doesn't know what it means. And drop your take in the comments, because I read them and it helps shape what I cover next.